Welcome back. It's the Dividend Dudes here. We got Tom and Brian and myself, the dude behind the camera. We've got another stock for you guys this week. This is Devon Energy. This one is interesting. If you've been following along with the journey here, we've almost purchased it a little while back. And now we're looking at reviewing some very interesting stuff that's been happening. So why don't we just jump right in? We got the financials in front of us. Let's go. What are we seeing here?
So Devon Energy, if you've been following along with us, this is a stock that in our portfolio is our worst performer. This one has not done us well in terms of the gain loss on the principal of the account. However, when we bought them, they paid a 10% dividend. We've had them for about 2 years. Now this year they're paying a 6% dividend. So when you see the negative 15%, you're thinking, well, why are they looking at this stock? We've actually broken even just because of the dividends. So looking at the company in itself, Devon Energy is they're a natural gas producer. They produce oil and they do a lot of it through shale, and they're mainly based out of the United States. They're one of the large 3 companies in the United States for that. So the industry that they're in is pretty solid. I mean, this is a pretty stable, able to provide good dividend checks for a long time type of business. That's why we're interested. So whether or not we would add them to our portfolio next month is why we're talking about the stock this month, to see, okay, what's going on with it? What are the news articles happening with it? What do their financials look like? And if you personally at home were going to decide, hey, do I need to buy this stock or add it to my portfolio? Maybe give you some information to help you make that decision as well.
Now, if you're playing along with a home game, you know that when we purchased this originally, it was one of the better stocks. And for months, it was our top performing stock.
Yeah, it was.
And it's gone down since. So in this video, we're going to go through, okay, what happened? Why did it go down? And why are we considering buying it now?
So Devon had an acquisition that they were trying to get through with Marathon, and they lost it. And their cash flow, in fact, if you look at the performance of Devon over the course of 5 years, you go all the way back to 2018, you can see that their stock price is about $27.45. All the way to today, we're trading about $45.50. That sounds great, but if you look at what they've done since 2022 until now, they've not had a good couple of years. So financially, their net revenue, in fact, let's scroll all the way down to their net revenue, go to their statements, and we want to look at their income statement. We want to take a look at what's happening with this business over a long period of time. So here's a business that, as far as the stock price is concerned, has had a pretty difficult set of 2 years in terms of capital appreciation. But when you go back to their total revenue, back in 2019, they were a $6 billion operation. Today, as of 2023, then they did their annual report, they're at a $15.2 billion operation. So they've almost tripled in size. Now, their stock should have done the same thing. It did not do that. Well, why did it not do that? Well, if you go over to their cash flow statement, they've been paying lots of dividends, and you can see those reflected in the net change of cash. Now, that actually shows up a little bit more poignantly over the, is it poignant? Poignant?
Is that a word?
It's a word.
Poignant?
It's like meme or meme.
Poignant.
Poignant. Poignantly. It shows up poignantly.
I don't think you're supposed to pronounce the G.
I'm not going to hear the end of this. It's meme poignantly. Yeah. We're going to keep going.
What's sequentially again? Sequentially?
Sequentially. So let's go back to their their quarterly statement. So we talked about their net revenue. It's a $15 billion gross revenue company now. But if you look at their cash flow, the last 5 quarters, 4 of those 5 did not look pretty good. They, negative $567 million. Last quarter before this most recent one was 579 in the red. These are negative cash flow quarters. Now that doesn't mean the company's necessarily doing bad. That just means that money's leaving their bank account. So revenue's all still there. Now this most recent quarter though, we see a positive change. Now what happened to make that? Their special dividends have been reduced down to 6% from 10. Their acquisition is no longer taking place, but their operations overall are still looking pretty good. So if we go back to the balance sheet, you want to check to see some of the basic things that we always look at. We want to look at the total assets, see what those are doing long term. Now typically those are, if you're not familiar with stocks, that's the stuff you own. So you start 5 quarters ago, $23 billion of assets. Coming up to today, you're at 24.9, or basically $25 billion of assets. You look at their liabilities, and their total liabilities and total debt is also increasing, but not nearly as much. All right, so if you're talking a stock that pays a dividend, you want to make sure that that dividend is sustainable. And when we bought this stock, you can go back to that video, we said that 10% was too high for these guys, that they should be hovering around 5 to 6%, and that's actually what happened. So, right. Hey, we did a good job. But as far as their payout ratio, if you come down here, you can see that their payout ratio, and what this means is basically you're looking at the percentage of their earnings that they have to use to pay their dividend. And normally you like to see, kind of like a mortgage, like a bank, you want to be between 20 and 30%, not really over 30, 28%, 30%. They're paying a little bit high, but this is in an industry that does a lot of natural gas, a lot of oil, a lot of pretty sustainable, solid, predictable income space. So they can cover that dividend by 216%, which is pretty good. And something that I want to highlight to people, that when we buy stocks, I mean, you hear about these stocks that go up thousands of percent, and that sounds really exciting, but you can also lose a lot of money doing that. So this stock we are excited about because of something that may not seem exciting at first, but I want to show you something. You see this 10-year growth rate here? That's 12.8%. So if you buy a share in Devon Energy, it's about 46 bucks. If you look at the average per share average that they're going to pay, you're going to get about $2.16 over the course of 1 year. Now, why we like a stock like this is because of something that people don't tend to think about when they're buying it in the short term. Over the course of 1 year, you're going to make that $2.16. Next year, it's $3.10. If you're assuming their 10-year growth rate. The year after that, it's $3.47. The year after that, it's $3.89. The year after that, it's $4.36. I mean, you can see it just keeps going and going. Over the course of 10 years, I mean, you're getting like $6, $7 for the whole year for that first share that you bought. And you made the dividend checks the whole time that you did that. So now what you do with those dividend checks, it's totally up to you. You can buy a lot of fancy stuff like I do, or you can reinvest them. I mean, or you can buy NVIDIA, more risky stocks for that stuff.
And the point is this, that we look for dividend growth stocks, not just the NVIDIAs that have wild growth in the stock itself and the ticker symbol. We look for the dividends to actually grow over time, which will give us money. And this scales. So if you buy, I mean, it's $2.16 a share. If you have 10 shares, that's $21 for the year. If you have 100 shares, that's $216 a share for the year. So, of course, the more you buy, the more you're going to get. And that's what we're talking about here is you buy into it and you keep buying into it. You get more and more shares. You're getting more and more dividends each year. That grows every single year.
That's part to play in the snowball. The reason why we like Devon is because their income is solid. They show a long-term track record, poignant. So they show a long-term growth rate on the business model that they have. So they've got a net revenue that's increasing. They got gross revenue increasing. They're prudent with that investments. They're not spending too much in the payout ratio. Now, back when they were paying a 10% dividend, they probably were paying a little bit too much. One of the things we look at is not just the statements on the financial side of things. We also like to look at their earnings, all of the metrics that you see there. Now, if you don't understand these things, that's okay. If you got a financial advisor, you can ask them questions. They'll help you out through that. But just so you know that one of the things, a quick metric you can look at it is earnings per share. As long as earnings per share is above 1 for the year, that means they made money. If it's below that number, they're not making money. So the other metric that we like to see is their price for earnings. So we go through all of these things when we're looking at the stock individually. We don't necessarily need to cover that with you right now in the video. We're just looking at whether or not it might be a good thing. So we look at the finances, and then the next thing we look at is what's going on with the business, the news and the article. For that, we have a couple things.
All right, so we covered some numbers here. Let's talk what is happening in the news. What updates are happening? Because we owned some of it. It was one of our worst performing. Like with everything going on, we said no last time. What's happening in the news right now that might potentially be changing our take?
Yeah, so when I look at a stock, I like to start with analyst ratings just to kind of get an idea of what other people think of it. I don't solely go on these ratings, but for Devon, they're pretty good. They're strong buy or neutral on the stock itself. And there's a couple reasons why. One is their historical earnings quarter over quarter are either matching or beating what the analyst ratings think or estimate that they're going to get. So that's always a great sign for a company. When you can beat the analysts, it's just a happy day. The second thing that we look for are things that the company is doing to increase revenue, increase the business to move forward instead of just relying on their laurels, or in this case, their oil fields. So they are looking to acquire a company, and unfortunately, the last few times they've tried, they failed. They tried to get Marathon Oil. If you look at this article, you got ConocoPhillips who beat them out. Scroll down. There's a couple other ones that they tried to do with Crown Rock, where Occidental Petroleum beat them out again. Cord Energy also. So they haven't had a great luck on acquiring a company at this point to increase their real estate in the Western United States oil industry.
I would think though that for a business that wants to make acquisitions, that if you say, hey, this is my limit, it's kind of like going to buy a house from a real estate agent. If you say, hey, I can only buy this size of a house, and the agent keeps showing you houses that are more expensive, you're like, no, I said this price. I think that's
it's
just
nice to see,
prudence.
they're being fiscally responsible with the free cash flow that they have, so they don't overspend.
Right. So we like that. Now, the ones that are remaining, there's not a lot of competition left in the space for them to make the further acquisition. So I think long term they might be okay. And I do believe Seeking Alpha mentioned that in their article, where they talked about like, hey, they lost out on these past ones, but that's no guarantee that they're going to get the same kind of competition with the next ones.
Right.
So.
And Devon has one of the largest oil acreage in the United States, of the Delaware Basin. They're also in a couple other ones that they're trying to expand in. So let's look at how Devon actually makes their money. We know they have a net income of $6 billion, but where did that really come from? If you look on the left-hand side here, you got oil, natural gas, oils, and liquids, which is the NGL derivatives, and quote-unquote other revenue. You could follow the stream over to find where their revenue comes from and then what's taken out of that to get to that net income. One thing that we look at personally is the operating income, which is $7.9 billion. So when they sell and do their service, that's what they're getting their money. They got nearly $8 billion just in operating.
You ever wonder what those minority interests are? Like, you can dig into it. You can actually pull those up on the financial reports, but whenever you're glossing over a business, they show these things called minority interest, unusual items. They always show up in the balance sheet. Like, I wonder what those really are.
Or extra items.
It's probably some guy's like vacation in Cancun. It's like, yeah, I took the yacht out. It was $22 million.
Like the other revenue.
Yeah. There's just no category. Yeah, other operating expenses are $54 million. Like, how do you just misplace $54 million? Like, yeah, it was only $54 million. We don't know what it was.
We'll put that in other.
It's just other.
We don't have a category for
We
it.
don't have a category. So the news here talks about the dividend share history. You can see the spike where their yield is very high per share price. That was when it was about 10%. You can see the growth rate of that. It's being extrapolated a little bit over the 3-year rate because of what happened with that spike. So I wouldn't pay too much credence to the 89% growth rate. Look to the 10-year one for that. As far as the dividend yield history and they're able to sustain the payout ratio, I know there's a big push for electric vehicles. I don't have any problem with that. I know there's a big push from Toyota recently to do hybrid vehicles, but we still need oil and we still need natural gas. You need it to, run your oven unless you live in New York. You need the oil to produce even silicone chips. Like, it's still a necessary product. And the fact that it's produced here in the United States means that we don't have to deal with OPEC.
Well, shoot, all the automation and the manufacturing process that produces the electric cars, all those machines need oil to operate. So it's, even though you got an electric car, you still need the oil.
So all of this said, why are we looking and why are we bullish on, or at least we think we're bullish on Devon? Well, for one, if you look at their finances and you just do a simple stock chart analysis, like if we were just a technical indicator, we ignored all the finances, we didn't read the balance sheet, we didn't care about what the EPS was or the PE ratio or what the payout rate yield was. If you just go back 5 years and you look at where they've been trading, right now they're trading pretty close to where they were in 2022. So if you're trading on a trailing 52 weeks earnings and you look at where their stock price is, they are not at their low. The low was $40.47, but they're pretty darn close to that. So if you want a good value buy in a company that's got a stable business that has tripled in the past 5 years, This is a pretty close bet to do that. Now, are they going to continue to grow? We don't have a crystal ball, but we believe that it'll be pretty good, because if you look at some of the other metrics here, outside of all the news articles that are here, if you scroll down and you look at some of the other things, how they're doing compared to their competition, if you look at their net profit margin, you know, gross profit's one thing, but it's kind of more important to know what you take home. So we look at that compared to their, you know, the competition. Now this is just in the Schwab account. So if you look at their net profit margin here, you can see they're at 22.54%, and none of their competitors on this list are even close to that.
Right.
So as far as the industry sector that they're in, they're doing pretty good that way. So you've got a company that's been beat up on a price share basis. Their net income and their gross revenue have almost tripled. Their cash flow problems that they had from their original payout ratio, which is too high, are gone. Their payout ratio is below 50% for what they're making. And it looks like they've got some acquisitions that they're going to keep trying to do. But the over and underlying business that's local to the United States seems to be pretty healthy.
Yeah, this is a company that's looking to grow, and a growing company means more revenue,
Right.
more income, and that's what we like. So given their potential growth, their earnings, the free cash flow that they have on hand, and more importantly, the 6% dividend that they keep paying out, are we going to buy it in our next portfolio? Are you going to buy it? Should we buy it?
Yeah.
What do you think? Comment below.
Okay, and stay tuned for that stock pick video that we do each month to see what we decide to actually go for. And in the meantime, go ahead and check out this video, and we'll see you there.